Jere, so good to see you. We are talking RMD 101 today, the rules that catch retirees off guard. It's good to see you.
It's good to see you, Erin.
All right, let's dive right in. Required minimum distributions are not just about taking money out. They come with specific IRS rules that affect how, when, and where those dollars can be used. And understanding these basics can help you avoid penalties, manage taxes, and even support your favorite charity. So let's get into number one. Each account is separate. The IRS requires you to calculate the RMD from each of your pre-tax retirement accounts individually. How does this rule catch people off guard?
The biggest way is that IRAs can be aggregated. So you can put all of your IRA dollars together, use the December 31st date from the previous year, and then take it from one account. But you cannot do the same with 401ks. 401ks have to be separate.
Okay. Number two, you cannot use your RMDs to directly contribute to a Roth IRA. Why is that?
It's just the way the tax code's written. And a lot of times people think, well, I will take my RMD, then I'll turn around and reinvest that back into a Roth. And the reality is that's not possible, because in order to contribute to a Roth, you have to have earned income. So right. there's a difference between Roth conversions and Roth contributions.
Right. All right. On the other hand, though, using an RMD for other expenses is okay. Once the RMD is taken, the cash is yours to use however you wish. Does that include reinvesting it in a taxable account?
Certainly. You can reinvest the RMD, so you can have it taken out and then reinvest it into what would be called a brokerage or a non-qualified account, and invest it however you'd like. And that does trip people up quite a bit. For some reason, they think that they have to spend that RMD, or they have to do something to spend it, but you can reinvest it. That's totally fine.
All right. Number four, you can use RMDs for charitable donations. How does this work?
So there's really two ways. You can take your RMD and then pay the tax liability, and then turn around and give a donation to whatever charity that you wish. Or another way that you can do it is through what's called a qualified charitable distribution, or a QCD, where you move money directly from the IRA to the charity. And that might be beneficial if you're already giving to charities. For example, if you're already putting money in the offering plate on Sunday, there might be a better tax efficient way to do it. So
right. All right. And then number five, I feel like people understand this, but maybe not all the implications that come with it. RMDs are taxable.
Yeah, it's really a forced distribution, and that's why they're taxable. The IRS wants to get their tax revenue on tax deferred dollars, and the age of which those start is 70 and a half to 75, depending on which year you were born. But that's a little bit misleading, because the longer that the money sits in there, the bigger you become a partner with the IRS at a future time, and that could be when tax rates are even higher. So you really want to make sure that you're managing those IRA distributions how you want to, not just through the forced RMD. The other thing with the RMD table is they do get proportionally bigger as you go. Mm-hmm. So it forces you to take out a bigger and bigger distribution every year. So.
Mm-hmm. And people might not even realize too that larger RMDs could affect their Social Security and Medicare.
Yeah, and Medicare, Social Security, capital gains rates on other investment income.
Right.
So that forced distribution really needs to be managed well.
Right. Proactive planning is key here. Jere, if somebody wants to talk to you about managing their RMDs and lowering their taxes in retirement, what's the best way to reach you?
Yeah, best way to reach us is at northernwaywm.com. You can find a bunch of information there on the website of what it is that we do and how we help do those type of things. So be happy to get you pointed in the right direction.
Great. Jere, thank you.
Thank you, Erin. Take care.